Joining us now, Jeremy Nelson, partner at Element Wealth. Jeremy, good morning. Thanks for coming in.
Appreciate you having me.
You bet. So, been watching, as Rhino describes it, the kangaroo jumping up and down on a daily basis, including today.
Yeah,
what's going on? So the Dow's up 313.
Yeah, so the Bank of England came out last night. They're taking some measures to buy some longer-term bonds to support their currency, and the market is responding well to that this morning.
Well, interesting maneuvers across the pond, combination of fiscal and monetary policy, and lots of concerns coming out from the investment community that they've cut taxes so much that they may have a problem paying the bills, essentially, and it could run up deficit spending and just can't fund the government. So there's nervousness about that.
Yeah, this becomes a major issue where, look, tax cuts are great because government's inefficient in how it spends money.
Sure.
It's better to put it in people's pockets.
Yeah.
But you have to balance that with cutting spending.
Right.
If you don't cut the spending and you cut your revenue source, then you just blow deficits out.
That's how we got $31 trillion of debt.
We've been doing it for a long time. Yeah. And essentially what's happened, too, is that with the U.S. being more aggressive on rate hikes, it's created a flood of money into the U.S., putting a lot of strength on the dollar, which is now having ripple effects across the globe. And this week, so a few weeks ago I said, look, 75%, I feel like we've probably seen the bottom. Well, we're retesting the bottom right now, and we are holding. So this is a very important level. The 25% caveat was you just don't know what the Fed's going to do. And I wasn't surprised by the fact that they went 75 basis points again. In fact, I said they should. The issue was the messaging. They were so hawkish. If they came out and said, hey, look, inflation's stubborn, we're going 75 basis points, but, we realize that there's a lag effect to these things, and they had a little softer message, the market would have responded reasonably well. But they've been very hawkish. It's created a little bit of fear, and here we are retesting the lows in the market.
Yeah, and you and I enjoy wonking out with you. But for our audience, a couple of things. Let's explain why that a strong dollar, some people win with a strong dollar, some parties lose with a strong dollar.
Yes.
Let's explain how that works.
So when the dollar is strong, it makes our goods more expensive. So it's harder for other countries.
To those in other countries, yeah.
It makes it harder for people in other countries to buy our stuff.
Yeah, what we mean by ours, goods we're selling abroad.
Yeah.
Companies are selling abroad, more expensive, takes more of their money.
If I'm Apple and I'm selling iPhones, right, it is now more expensive for those people because their currency is not worth as much. So Apple has to look at maybe raising prices over there in order to maintain their margins.
Right.
It is good for us as importers,
consumers.
Right? So as consumers, if we want to buy, cheap stuff from overseas, then it's even cheaper because our dollar is stronger.
Goes further.
Great for us if we want to go travel abroad. If you want to go to Mexico for a vacation or Canada or Europe or something like that, the dollar goes a long way.
Yeah, and so I saw where the pound, the British pound, because of these various fiscal policies, which has a tendency to decrease the value of the dollar, the combination in their case of fiscal and monetary policies. So it is at its lowest level relative to the dollar in like 20-something years or maybe ever.
Yeah, I mean, it's astronomical. So I had a friend of mine in college that I played golf with, and he was from England. And back then, the pound was 2-to-1 for the dollar. Yeah. And so here we are talking about them being at parity. I think we hit 103 yesterday.
I think that's right.
So we've never seen this. This is pretty astronomical to see this kind of weakness in their currency. You're seeing it with the euro as well. So basically, all European currencies are really in the tank.
Yeah. So for those of us in the U.S., if you're thinking about a European vacation, now's the time to do it. Right. It costs a lot less money when you start exchanging the dollar and to their currency.
Yeah.
So, and there's also reports of some of these countries buying dollars, right? There's a demand for dollars as a result of the strength of the dollar.
Well, actually,
is that right?
You're seeing them dumping it now.
Dumping the dollar. That's
They're
right.
dumping
I got
the
it
dollar.
backwards. My bad.
Yeah.
My
so
apologies.
the Japanese actually, in an effort to hit the dollar sum, started dumping their
try
reserves.
to devalue the dollar. They're dumping it. Right. My bad. Because buying it would actually increase.
Buying it would increase the value of the dollar.
Yes. So, and it's probably a lot of folks don't know that foreign countries do have stores, reserves of the dollar.
Yes, and what you're seeing is a diversification now. So the U.S., ever since the financial crisis, has been amplified as the safe haven of the world.
Right.
And the dollar has continued to be very, very strong, which has created some stress around the world. And you are starting to see currencies or countries diversifying their foreign reserves and actually beginning to take other forms of currency as payment.
Right. And so all of that's figuring in to the dynamics that we are currently witnessing. Now, let's talk to our audience, many of whom I've got some listeners here that have texted in, Jeremy, and said, I was thinking about retiring. I know you're hearing this a lot. And I'm looking at my savings, my 401k, my nest eggs, et cetera, my investments. And given their performance over the last year, I've got to delay that.
Yeah. No, that's so I think that what we're going through right now, if you are on the fence with being able to afford to retire, you probably need to hang in there a little bit longer.
Yeah.
This is temporary. So if you go back and you look at let's just say you're getting close to retirement, you've got half of your money in stocks and half of your money in bonds, right? Half for long-term growth, half for kind of safety and income.
Right.
The stock market right now is not down nearly what it was in 2008. We're not even down as far as we went in COVID, right? We're talking about a market that's corrected a quarter, 25%.
Yeah.
What's happening, though, is that because interest rates have moved up at a pace that we have never seen in recorded history, right? That's how bad the bond market is right now. Your bond portfolio is way down. Now, that isn't the end of the world because bonds will mature. They are now. Then, as you reinvest, you're going to get higher interest rates. So, I think that you will get a recovery and better performance in bonds going forward. I mean, heck, Gerard, you can get. Yesterday it was 4.3. Today it's 4.2%.
2 year
on a 2-year U.S. Treasury bond.
Incredible.
We haven't seen yields like that since the early 2000s.
So that's the so-called silver lining. Now you could compare that to possible increases in value of equity holdings. And the amount of time it would take to get that same return on a fixed income security like that, it depending on which way the market goes, right?
It really depends.
But if you compared it to, say, the past year, it's like 7-1 or something like that.
Yeah. So with the stock market, though, we've been in a massive uptrend.
Yep.
Since March of 2009. There is a real risk that this is the beginning of a multi-year period of turbulence. So it is going to be important for people to own fixed income securities and preserve some capital because this is not like a correction where all of a sudden we're going to wash out and then we're just going to head right back up and keep hitting new highs like we've seen over the past decade. This is probably the beginning of something bigger because inflationary periods don't just spike and end.
Right.
We've come on, and I firmly believe this, by the end of the year, you're going to see much lower inflation numbers.
Yep.
100% on that. But it's still not going to be at the Fed's target. They're going to have to keep interest rates up longer. And we've lost, the safety net that's called the Fed put.
Yeah. But again, though, you have an opportunity, if you wanted to rotate, you have an opportunity to invest in some fixed income, very low risk, no risk securities, essentially.
Yeah,
you get some money.
You can sit there, collect your 4%, and if the market washes out, you can sell them and buy more equities.
Let's take a break here, and when we come back, I want you to kind of weigh in on the Fed's strategy and what your thoughts are on that. We've got Jeremy
Absolutely.
Nelson, a partner at Element Wealth, in the Element Wealth Studios, and we'll be right back. In the Element Wealth Studios, Jeremy Nelson, partner at Element Wealth, our guest. All right, so we kind of hashed out the market dynamics, and right now it's just volatility is the name of the game, it seems like, and it's a little difficult to project where all this is going. And I agree with you. It wasn't so much that Jay Powell came out and said, yeah, we're raising rates 75 basis points. It's what he said that day. He gave no indication that there's any relief in sight or any pivoting in the offing as far as increasing rates and his rate management strategy.
Yeah, I think, we've been talking about this for months now. They were so far behind. They had to make major moves. The first 75 basis point hike was the first one since 1994, as you pointed out, when Orange County went bankrupt.
Yeah.
Then they go again and again. I don't disagree with the fact that they had to go aggressive to catch up because they were so far behind. Just admit, hey, we were behind. We're having to play catch up. There's going to be a lag effect here for this to hit inflation. Instead of just coming out and being so hawkish, you trained the market for the past 14 years. Hey, trust us, we've got your back. And then all of a sudden, they've completely turned. I was thinking about it's like, when you've got kids and sometimes you let them run all over you, and then all of a sudden, you got to put them in their place, right? Well, that's kind of what they've done, right? They let the market run all over them, dictate everything that they were going to do for 14 years, and now all of a sudden they're kind of saying, no, hey, we're daddy.
Interesting analogy, but I think spot on. And a couple of the Fed governors are even more, I guess, emphatic on the need to continue to raise rates. I mean, they're more hawkish than even Powell is. So he's got kind of an interesting group he's trying to reel in there.
He is in a bad spot. Bullard is the one that I like, and he's been on record saying they were behind already.
Yeah.
The reality is they have to be patient, and they have to give some time for these rate hikes to take effect.
Yeah.
The number one worst thing they can do, I don't know if you saw Jeremy Siegel's interview.
I did.
Okay, well, I actually had a meeting with Siegel in New York a few weeks ago.
He is.
So Jeremy Siegel's professor at Wharton.
Yep.
He did an interview, which is now kind of pretty famous, last week on CNBC, and he was very critical of the Fed.
Yes.
He said basically, they don't know what they're doing. They were so far behind. They said inflation was under control, and now they're totally missing the boat because they're looking in the rearview mirror instead of looking at where things are going. And he is absolutely right. The Fed is looking in the rearview mirror. If you look on a go-forward basis and you look at 7% mortgages, I had a dinner with some friends this weekend. We had our kids watch some football. They were thinking about buying a new house. They can't afford it now. And these are good, normal, middle-class people that can't afford to buy a new home now. So they're going to stay in their house, right? You're going to see that across the board. We're seeing declines in the growth rate in housing prices that we've never seen. So you have to give time for these rate hikes to take effect, and then just don't come out and be so blatantly hawkish. You raised it 75 basis points 3 times in a row. We know you're fighting inflation. So just let us know, hey, we're fighting inflation, but there's a lag effect, and then and message things better to the market.
All right, so when they open up these statements and they start to cry when they see the destruction of value or the decrease in the value of their accounts from one month to the next, which has been kind of a thing for the last few months, what do you tell them? What should folks do?
So That's a nuanced question, and it kind of depends, right? So
Sure.
if we own money outside of IRAs, like let's say that we sold a business or there was an inheritance or we just saved money outside of qualified plans, well, if you liquidate those assets, you've probably got capital gains,
Right.
right? So do you want to write a check to the government just to make yourself feel better? Because that's what you're doing. That's not good. If you own high-quality assets, right, dividend-paying stocks, good companies with good balance sheets, you just got to hold them and go through it. Now, if you own IRA assets, I would not advocate selling today, right? So rule number 1, the trend is your friend. Well, the trend's broken. Rule number 2, don't fight the Fed. Well, the Fed ain't your friend, right? But rule number 3 is be wary of the crowded extremes. And what that means is when everyone's selling, it's probably the time to start thinking about buying. So with the Fed being aggressive, with the trend being broken, I would say today it's not the time to sell right now. If you want to sell, right, today the market's up because we got oversold.
Yeah.
Trim positions on strength versus weakness. Begin to look at your fixed income securities. You can actually get reasonable yield there.
Yeah.
And if we do go into a big recession, inflation's going away. And interest rates are going to drop. So bonds, good high quality, don't buy junk bonds. Good high quality bonds will actually rally in value.
Yeah. It makes total sense. So your crystal ball, what does it say about recession, how severe it will be, and when we pop out of it?
Yeah, so I've been steadfast in saying that we are not in a recession right now.
Okay.
We will go into one in all likelihood, probably the latter part of next year, maybe 2024.
Really?
Mm-hmm.
So you think even the first 3 quarters or so of 23? So
Yeah.
how are you defining recession in this context?
So in this context, what you've got to look at is a significant contraction in the economy, right? So we're not getting an actual contraction. You've got the labor market still reasonably strong, right? You've got a 4% unemployment rate, and corporate profits are going up. In order to really, and everyone's got to remember, there is such a distortion because of all the COVID money, and we truly are in something that we've never seen.
Sitting in banks, by the way.
Yeah.
Flush with cash.
Flush with cash. The bank's balance sheets are good. Corporate balance sheets are good. The consumer, we're starting to see like credit card debt going up, but overall the consumer's still pretty good, pretty resilient. So with that backdrop, it's really hard to say that we're in a recession.
Okay.
What you will see is corporate profits begin to go down. Right. You'll see the unemployment rate going up
During a recession.
Yes. Yeah.
Yes.
So you really need to see the unemployment rate going up. You need to see corporate profits getting hit. You need to see a contraction in economic activity, which we still haven't seen yet.
Powell said that. Well, we have had a slight measurable contraction quarter to quarter, and therefore that kind of meets the technical definition.
When you factor in inflation, right? But if you look at the nominal growth rates,
right.
they've been really, really strong. There's a weird thing going on with labor productivity that's skewing the number right now.
I think that's right as well. And Powell made it very clear. Yeah, we need people to lose their jobs. Pain was the word he used.
And it is their fault.
Right.
I mean,
this was avoidable. I think
this was totally avoidable. They completely misplayed monetary policy once we got past the initial phases of COVID.
Yeah. And of course, you're fighting poor fiscal policy. It's crazy to me, Jeremy, because you got the Fed that's trying to fight inflation with monetary policy, and you got the federal government with fiscal policy just dropping more money out of helicopters.
We did a call a couple of years ago with Ben Bernanke, former Federal Reserve Chairman, and his point was you can only bail out bad fiscal policy with monetary policy for so long.
That's a great point. I love that.
And we're seeing
what's happening right now.
We're seeing that happening now. So Washington needs to wake up and start putting together some proposals that actually make sense.
Yeah, because the interest rates, of course, are designed to clobber demand, right? Which is expected to reduce inflation. But there's nothing coming out, but they don't have any control over supply. From a monetary policy perspective, the Fed doesn't. That is something the government could address, but there's just no interest in any sort of pro-growth policies that would boost supply.
Yeah,
none coming out of Washington. I've scratched my head and tried to figure out which of those policies actually bolster supply and incentivize creating more, producing more. I haven't seen any.
They're more worried about the sensationalized issues
no doubt
that
about it.
get clicks.
I call them, I've described yesterday, they have two idols, climate change and racism. That's pretty much it. Those are the idols. They're genuflecting at the altars of those. Appreciate you coming in, Jerry. Right. Always very insightful.
Thanks appreciate it again. Thanks.
Jeremy Nelson, partner at Element Wealth, has been our guest. We're in the Element Wealth studios. We're coming right back.